90% of startups fail. A good professional diligence effort can drop that to 50%. A lot of angel investors who are trying this asset class for the first time don't know what a good due diligence effort looks like. Perhaps they're investing in sectors they don't know well. One of the things that I thought was really intriguing about being a part of an angel network and leading that community was seeing investors learn from other investors.
Hi, welcome to Tech Careers and Money Talk. I'm your host, Christopher Nelson. And today we want to talk about something that's really important for technology employees, which is your venture portfolio. Many of us, as we get into technology, we're earning equity and we're building wealth, we start investing back into tech. But there's so many ways to do it. And like anything else in your portfolio, you need to be disciplined. I'm excited to introduce everybody today to Claire England. Claire England is an investing partner with GPG Ventures here in Texas. And she also spent a good portion of her career working with a lot of limited partners like yourselves, investing in venture, helping people putting together a thesis for their portfolio. We're excited to learn that from her today. And we're also going to hear about her story of how she started in public relations and then went into the VC world to be the partner that she is today. Excited to introduce you to Claire. Let's get into the conversation right now. Welcome to Tech Careers and Money Talk. Excited that you joined us here today. I'm excited to introduce everybody to Claire England. Claire is an investment partner at GPG Ventures and a former Kauffman Fellow. She's been in venture for over 10 years and started her career in public relations, which I think is so interesting because many people have this concept that you either have to be in product management, you have to be a CEO to get into venture. But Claire's here to buck that trend and tell us how it worked for her.
Yeah, thank you so much.
Welcome.
Thanks so much, Christopher. It's great to be here. And I'm excited to dig into some portfolio theory. But first, we'll talk about my background a little bit. So, yeah, I'm a bit of a unique bird when it comes to venture because not only do I come from a PR and marketing background, but I spent the first decade of my career in social impact nonprofits. And I've only come across I don't know, 3 or 4 other VCs who spent some of their career in nonprofits. So this is definitely a unique path. Actually, a lot of the people I know who have broken into VC did so through first investment banking, getting a finance degree or an MBA. It's certainly become a lot more common in recent years for people to break into VC after having been with a startup and having some success in entrepreneurship. So love seeing people who come from a product background or CEO background because they know what that entrepreneurship and founder experience is like.
But for yourself, I think it's also important to understand that marketing, PR for startup companies and for venture capital firms is critical in their growth as well. So it seems like your trajectory, you came in with having some PR experience and then you started working for a startup yourself. Was that sort of the gateway to getting into venture?
I did. Yes, that's correct. I spent a couple of years running client accounts for a social media services startup and caught the tech bug, caught the entrepreneurship bug, and really started exploring the entrepreneur ecosystem here in Austin, which, in the 2010, 2011 was still developing, but certainly growing. It's become a whole nother beast now. It's so much larger and exciting here. But yeah, I was that opportunity to leave nonprofits and work with a for-profit startup really catalyzed my interest in innovation. And what's fascinating, though, back to the nonprofits, is how similar, there really are some parallels between nonprofits and startups. Both have to, at least for early stage startups, have to work with fewer resources, with limited resources. Both nonprofits and startups have to fundraise. Not all of them, obviously, on the startup side will fundraise, but a lot of them need to really grow. And then startup leaders founders and nonprofit leaders are very mission driven. So, they're goal oriented and mission driven. So it's been interesting to me. I know I don't fit the mold for a lot of VCs, but I actually think that this background in social impact and PR and marketing is kind of an advantage for me as a VC. Uh, I bring a different perspective, and I think it's valuable to have different perspectives in VC.
100%. And I think the fascinating thing that you highlight too is that when you have experiences and you're able to tie the results in those experiences and the commonalities in those experiences to then where you want to move into, and I tell people this when they want to do career pivots all the time, you can then start mapping things out that are similar. And I would actually state that from your experience, if you're in a nonprofit and you're familiar with let's say you need to raise funds or die, then when you come into a startup environment where people are focused on the technology, the build, and they need that kind of support, you can play an instrumental role in helping, whether it's a startup or whether it's a VC, really get traction quickly.
Indeed, and beyond that, VC and I would posit startups as well in a lot of ways are a people business, a relationship business, and
That's right.
having spent so many years in fundraising and media relations and marketing, those are all very relationship driven. So there's something to be said for VCs who have high EQ and can build
Mm.
effective relationships with founders and know how to support startup leaders and their fellow investors. So I think all of that is very important for VCs and any type of investor, not just professional VCs. And it's something that Kaufman Fellows believes very strongly in is high EQ and developing the fellows as leaders for the future of venture capital. And I'm I can say I'm not a former Kaufman Fellow because we're fellows for life. Once we're in the program, we're in. So
You're in.
even though I did graduate from the 2-year program in 2018, I'm still very active in the Kaufman Fellows network, and it's incredibly valuable for those of us who are part of it.
Yeah, walk us through real quick. Give a highlight to people listening as to what that
Mhm.
is, and then also what, like for yourself, where was that in the development of your career, and what did it mean to go through that program and now continue to participate?
So Kaufman Fellows is in the vein of like the Henry Crown Fellows, the Eisenhower Fellows. These are top notch fellowships for people in a certain career or wishing to have a certain focus. In the case of Kaufman Fellows, I think it's most akin to an MBA for venture capital. It's a 2-year program. We meet in person during those 2 years with our classmates for modules quarterly, and it is leadership development. It's developing us as an investor and helping us become the best version of ourselves professionally and personally that we can. And that sounds a little foo-foo, but it works, and I think it's incredibly valuable. And there's a reason why it's become known as a top program for venture capitalists. There are 880 of us worldwide in I think now 58 countries. So it's a really incredible network. And the class before mine in 2015, they started allowing institutional LPs into the program. So that has just crystallized even more the value of the program because we're surrounded not just by other GPs from VC funds, but also um, LPs, institutional LP investors from whom we can learn. And every class, at least during my time, also had people from 500 startups and Endeavor, so entrepreneur support organizations too. So having that broad swath of people from the ecosystem is really valuable. Um, yeah, I didn't expect to make dear friends in a VC program, but I did, and Kaufman Fellows is worth being a part of for those who are considering it.
Now, as your career was growing inside of the venture capital world, was it this experience that really helped round you out and fill in some of those other areas for you to make you the complete VC, if you would?
I don't think any of us is ever a complete VC. We're always aspiring to be better, and always learning, or we're not doing a good job. But um, yes, I think Kauffman Fellows was a big piece of that. But when I was nominated to Kauffman Fellows, I was leading Central Texas Angel Network, which is it was a top 10 to 15 most active angel group in the country at the time when I took over the reins. And during my tenure, the board and I took it to number one in the country in terms of both deals funded and dollars invested. So
Wow.
that experience, I think, alongside my Kauffman Fellows time, really crystallized um, my knowledge base in investing, both with angel investing and VC. And I think that if you're a really good angel investor and uh, spend a lot of time thinking about and digging into due diligence with your angel investing, you can be just as good or better than most VCs.
That's a very interesting perspective. What I'm hearing you say is when you start at that micro level and the level of work, the level of unknowns that you need to do to be placing small amounts of capital in many times over. It's
Mhm.
really those repetitions that then get you into that mindset of how you can continue to grow in that profession.
Exactly, and not only that, but you one tends to think differently about one's investing and the thesis when you're writing a check from your own bank account versus writing a check that is from LPs who've invested in your fund. So there's a bit of a different mindset with angel investing. But yeah, back to your original question, I think a combination of learning from very experienced investors when I was running the LP community, the Angel Network, and Kauffman Fellows. And then when I stepped down from leading the Angel Network in 2019, I had a chance to join Portfolio as a fund manager. And I've been a partner in two funds at Portfolio, which has really that helped me up level my skill set as well. And Trish Costello is not just the founding CEO of Portfolio, but she was the founding CEO of Kauffman Fellows. And I've learned so much from her as well and from my fellow partners at Portfolio.
Wow, it sounds like then once you got in and you really started to figure out where you could play in the VC world, that the learning never stopped, the opportunities never stopped, and now here you are at, I mean, it was the move to GPG, CPG, GPG.
GPG.
Yeah, was very recent.
It was just a little over a month ago, and it was time for me to go back to full time work. I've been a part time fund manager and doing a lot of consulting over the last 4 years, including being executive in residence for TechStars Tulsa and being a partner with Lohas, which is an impact advisory firm. I wore a number of different hats and loved every minute of it, but having the opportunity to go full energy, put all of my energy into one role and working with just a stellar team at GPG Ventures. I'm very excited to be opening their Austin office. They're a firm that's based in Dallas with an office in Houston. So I believe we may be the first, perhaps the only firm in Texas to VC firm. Now, there are
Right.
others who have multiple offices around the state, including Capital Factory, but I believe that we're the first VC firm to have three offices in major Texas cities.
And what kind of investments will you be placing in that firm?
We are focused 75% on healthcare and
Mm.
about 25% on general tech, B2B SaaS, AI, ML, enterprise. On the healthcare side of things, we do just about everything but healthcare services. So we've invested in therapeutics, diagnostics, medical devices. Pharma is under the therapeutic side. Um, Consumer health and health IT, health tech. And there's a lot of digital health in Austin, so it's
Oh,
it's
yes.
And with the medical school being here, we still have, oh, as compared to Boston or San Diego or even Houston, we have a relatively nascent healthcare startup community, but it's growing fast, and there are a lot of exciting things happening here.
And what is your thesis for your fund? Is it going to be a new fund you're opening, or you're in an office supporting of some broader funds?
I'm building out the Austin office to support the opportunities that we have as a firm wide. So we operate different than a lot of other VC firms in that we don't have a fund out of which we primarily invest. We have a couple of opportunity funds which are for follow-on opportunities. But when we first go into a deal, we partners do due diligence together, make an investing decision together, and we all co-invest together, usually with our families. And then we share out that deal to our LP network. And before I joined, in between the Houston and Dallas offices, that's a network of 650 unique LPs, high net worths, and family offices, 500 of whom are based mostly in Dallas and Houston. So I'm now adding my network of high net worth and accredited investors and family offices to the GPG network. And so each time we do a deal, we create an SPV, which is a special purpose vehicle, to invest together with our LPs in that opportunity. So we're giving individual accredited investors and family offices a chance to see deals that they might not otherwise see, especially when we're opening up room in the follow-on rounds for our portfolio companies.
That's really exciting because I know being an LP that then gives the opportunity to get into some first look situations that you have and be able to then bring capital alongside essentially larger players.
Yeah,
So that
and
and just wanted to finish that thought because I like that model too, because then incentives are aligned whenever you get the opportunity to go in first with GPs. There's a lot of incentives aligned there. So that's I didn't know that. That's great.
indeed, yeah, and the traditional model in VC is to create a fund, raise from LPs, both high net worth, family offices, and institutional, and then invest out of that fund. But I personally know a number of high net worth and family office LPs who like to do direct investing.
Mm.
And so instead of having that be kind of a secondary opportunity, almost an afterthought to a fund, GPG makes that our primary focus, and the fund is the secondary. So it's kind of flipping the script a little bit on VC in that respect.
Well, it is, and I think and now I'm getting real excited to talk about portfolio structure and those things as well, because as a very active LP myself, what I really enjoy about that is direct investments can be much more intimate. Number one, number two, they can also be much more impactful.
Mhm.
I also enjoy to like going into what I consider general VC funds, more blind funds, where you're putting the dollars forward and then the GPs are essentially managing that. Where here I can actually have, if I have a healthcare thesis in my family, or if I have AI ML thesis that I really want to go invest heavily, making the direct investment gets me a lot closer to what I'm trying to accomplish in the building of my portfolio.
Indeed. Yeah.
Yeah.
And I don't think one is necessarily better than the other. I think it's valuable for LPs to have a differentiated strategy across VC, to pick some great GPs who you believe in as an LP and invest in them, and let them use their expertise and find great deals to invest your capital out of their funds. And then also, if you have the inclination to do individual deals, the other thing I've heard from LPs is some just frankly don't have time to do a lot of individual direct investing. And so a model like GPG's, like my new firm, where we are the lead investors and we invite LPs to join us in that opportunity, means that we're the ones who will be following up with the founder and checking in and make sure things are going well. And if we have a board seat or an observer seat, we'll be paying close attention to how that company's doing. So we're operating as a professional VC in that capacity, but inviting our LPs to come alongside us in that journey and joining that SPV with us.
Right, right. And that to me is the value because as you stated, right, we want a very rich and diverse portfolio. So this to me is another when you're thinking about the VC, section of your portfolio, now you have an offering where you can have the direct investment alongside a mature and experienced operating partner that's driving that. And so it's definitely less overhead. 100%.
Indeed. A little bit, perhaps a little bit easier than straight up angel investing on one's own. Hopefully.
100%. Yes, 100%.
And hopefully a little
So
bit better de-risked as well.
so let's talk a little bit. I'd love to understand as we're sort of putting a bow on this, career section where you are now. What do you think some people get wrong, LPs get wrong about venture investing or seed investing?
Hmm. When it comes to individual angel investing, I'll put that one. I'll address that one first before I go into the fund discussion. LPs who are doing direct angel investing, and especially when they're doing it on their own, I think can be a mistake because you don't know what you don't know, and many angel investors will see failures up front and decide this asset class isn't for them. And perhaps they're just investing in some deals that a friend or a neighbor has brought to them or a family member. 90% of startups fail. And a good professional diligence effort can drop that to 50%. This is according to the research that's out there. A lot of angel investors who are trying this asset class for the first time don't know what a good due diligence effort looks like. Perhaps they're investing in sectors they don't know well. So, one of the things that I thought was really intriguing about being a part of an angel network and leading that community was seeing investors learn from other investors. And I think that when you have a chance to, portfolio theory is all about diversifying one's portfolio. And we tend to, as business leaders, invest in what we know. But if we're going to really have a diverse portfolio, we need to invest beyond that. How in the world can we possibly invest in what we don't know unless we surround ourselves with people who know those sectors? We're going to make poor investment decisions otherwise. So I think that number one is don't go it alone as an angel investor. I think that's one of the top pieces of advice I can give any LP looking at this asset class. And on the fund side, make sure you've done a really thorough job of diligencing that fund manager. Look at their history and make sure that you're seeing really accurate data around their past portfolio performance and what that looks like.
Yes. Well, Benjamin Franklin, due diligence is the mother of luck. So I love that because that's something that I see and try and help people understand all the time. And this is why this podcast is here, so we can have conversations around career equity you make and the money that you invest. It's so important to understand that a community of like-minded individuals is critical in being successful as an investor. And that stat that you rolled out, and I think that is compelling because the more you do due diligence, while the broader stats, the 90% failure, those are people that are taking on family money, family and friends putting in their own money. But when you look broader, you need to then understand when you're writing the check, if you have a portfolio of 10 companies and then half of them succeed, half of them fail, well, then you're probably going to come away with some upside in that scenario.
Exactly. And I have lots of thoughts on portfolio theory. We'll get into
Yes.
that shortly, I'm sure.
Well, we're going to get into that right now. So we're
Awesome.
going to take a little break right now, and we're going to be right back with Claire England. Okay, and welcome back. We're here with Claire England, and we're excited. In the second half of the show, we really want to talk about portfolio theory. We want to also talk about Claire and I met at a conference, and she was just started, we just started jamming a little bit on portfolio theory. And then she started sharing with me how seed investors need to develop their own portfolio thesis. And I said, please stop. Don't tell me anymore. I want to record this and I want to share it with the listeners of Tech Careers and Money Talk because I think they're going to get so much value from it. So, why don't you kick us off and let's get into this conversation of developing a thesis for your seed investing portfolio?
Thanks, Christopher. So, this was actually a project that I developed when I was in Kaufman Fellows. So, as part of the 2 year program, and here's another reason why I liken it to a mini MBA, we have to do a thesis project.
Mm.
And in my case, I created a whole white paper and slides around why creating an angel investing thesis is important. So it's called a framework for angel investing thesis development. And um, a few things about why this is critical. First of all, VCs write a thesis for their fund. This is part and parcel super important for venture capitalists to have a thesis for how they plan to go about doing their investing. And some people will also call it portfolio construction, but essentially it's your investing thesis. And I posit that it is as important for an angel investor or an individual LP to develop their investing thesis as it is for a VC. Um, for starters, it's really critical to help focus one's investing efforts. If you know exactly how and where and why you want to be doing this asset class, it can help you. Having a thesis can help you conserve your time and energy. Um,
Mm.
at least 2/3 of angels work full time. I think there's a misconception out there that a lot of accredited investors are the ultra wealthy, and that's not the case. The minimum barrier to entry for being an accredited investor is a 200K salary as an individual, or 300K if you're counting a spouse, or $1 million in assets, not including one's primary home. So a lot of people qualify as accredited investors and don't even realize it. Another reason why I think it's important is a thesis. Remembering one's thesis when you're doing the angel investing can help you make more clear headed decisions when you're faced with uncertainty. When you're trying to make those decisions around what, is this really the company I want to invest in? There's a lot of uncertainty around startups, and knowing your thesis and embracing that can help you make more clear headed decisions. And then,
So,
go ahead.
okay, because it sounds like then as you write out your thesis, you would go and you would find some quiet time away from investing, away from investments, and you write out your thesis for your seed investing portfolio.
Yeah.
And I do. And so I'd like to try and bring this to life a little bit because I was literally talking to a friend the other day who uh had one of his seed investments pop, and he was getting bought out, and it was a great thing. And so for his particular thesis, he went, wrote it out, and he leveraged it to be this reminder when you get swept up in the emotion. Because I think sometimes, like, this is where
Mhm.
these types of artifacts help us remove the emotion from the decision and remind ourselves of when, before we had all this dopamine swimming around in our brain because of a great meeting and great ideas, of really where we want to place our dollars.
Yes.
And it
And
sounds like that's what it is.
exactly. And interestingly, you're actually starting down the road of developing the thesis by saying it's for seed investments, because that's one
Mm.
piece of developing your investing thesis is what stage Are you only going to do seed, or do you want to seek out some later stage opportunities? Do you plan to do follow on rounds in your existing portfolio companies, or are you just going to invest one and done? Will you use your pro rata in future opportunities when that company goes back to raise their Series A or their Series B and beyond? So it also includes planning for the pace and sizing of your investments. So I think one of the things that individual investors need to be thinking about is this is a high risk asset class. Some people call it gambling, and I think that that's certainly there are some parallels there, but it to avoid seeming too much like gambling, it needs more forethought. So providing yourself a roadmap for how you want to build a portfolio and helping your just planning that out, like you said, getting away from the investments, stepping away from all the distractions, and composing this. And we can get into kind of some of the thought process around how you can do this in a minute if you'd like. But yeah, in my experience, historically, less than 15% of angels I surveyed had a fully developed thesis.
I think that there's a lot of challenges there. And this is exactly why I want to share all of this information with people. I want to be able to bring people like you here because what I found. So, I started a private equity company that helps technology employees diversify into real estate, commercial real estate, private equity because there was literally a void in their portfolio.
Mhm.
And from the hundreds of conversations I've had with accredited LPs, I would say 80% of technology employees, their portfolio looks like this: 30%, 40%, or 50% is in a single tech stock, which is the company that they work
Mm.
for,
Mhm.
right? And then you're going to have maybe 40% is just in broad market funds, the rest in the market.
Mhm.
And then they're going to have the rest is going to be in VC. And their entire portfolio does not have a purpose or direction other than grow, right? That when I ask people, well, what do you want this to do? I just want it to grow. And I think people need to, and especially technology employees that put so much time and effort in their work, spend so much time developing their careers, they need to understand the playbook of how you take a step back and put some thought into this. And so when you think about somebody's, personal net worth, and this is one of the things that I try to get people to think, like, what do you know of investors or targets? Because we're not trying to give advice here, people. We're just trying to understand what's theoretical, what we're seeing out there in the market. Is there a allocation that you generally speaking see, people who manage their portfolio with maturity allocating to venture?
Oh my goodness, that's a tough one because we had I had 200 LPs in my in Central Texas Angel Network, and that meant when founders would ask me, well, what are the LPs like? That's 200 different ways of doing investing. So every person has to approach this from their own financial situation and determine what's best for them. Now, that said, there are some good broad guidelines around developing an investing thesis, and some of these are rooted in portfolio theory and portfolio diversification. Historically, and this is probably 10, 20 years ago, this would have been true if not longer ago. Historically, one could invest in 10 startups and expect 5 of those to fail or not return much of the original investment, uh, and then expect a few to return 1 to 2x, maybe 3x, but you're looking for that one that would be the 10x plus that would balance the portfolio and help you return better than you would in the public markets or real estate. Now that has changed, and now experts are saying that to really diversify in this asset class, you need to have a portfolio of 20 to 30 startups. Now, if you're balancing that with fund investments, then you can think about how that looks as well. But but I think first of all, there's most of the people who explore the venture asset class are folks who already have their tech stocks and public market stocks, like you mentioned. And then their next move is to go into real estate. So whether they do some commercial real estate investing, multifamily, or single family home investing, that is typically the next step. And then the venture asset class is the next one. The advice I give individual investors who are considering getting into this asset class is this is not the place to risk your nest egg. It's high risk, potentially very high reward, but keep your nest egg in something more secure and know that this is a longer term play. The average time to exit in startups has, over the last few years, has been 7 to 10 years. Right now, that's even getting longer because of the lack of IPOs. So this is a longer term, high risk category, but conversely, high yield and high reward. There's a reason
Right.
why the private markets are known for making people wealthier. It is an opportunity for that.
It really is. And you brought up something that I'm curious if you have insight into, but as I spoke the other day, there's 732 unicorns, right? So private companies valuations over $1 billion. I track this because I look at the equity compensation side, for the listeners here. And um what I'm finding is that more companies are trading privately on secondary markets, and that is actually growing in size and scope. Are you seeing that from your side as well?
Yes, I think that's absolutely accurate. I think that's a growing space in part because of where the markets are now. And that's part of why I pushed back gently earlier when I said you've already started developing a thesis when you start calling it a seed thesis, because
Right.
I think that it does make sense to consider secondary markets and later stage opportunities when one is developing a venture asset class thesis.
And I just think too, it's so important that people get versed in venture, in private equity in general. I read this very telling article by The Atlantic the other day that now 20% of the public market has gone private, versus it was 4% in like 2004. But now here we are coming on 2024. And you think about all the private equity companies that are taking public companies off the market, going private, and they're talking about that market cap. We're talking about understanding how to do due diligence, thinking about privately traded secondary markets. All of these are going to be important tools that people have in their investing toolbox to be able to build wealth, going into the next 10 or 15 years.
Indeed. And to that point, I think one of the things that's well, we have an example in our own backyard. Dell went private after being public
Right?
for many years. So I think if you'd like, one of the things we can dive into is how specifically to go about developing one's investing thesis for venture asset class, because I do have some guidelines on what that looks like, and
I,
when you can find that time to set aside and kind of have some quiet where there aren't any distractions, I think this could be a great thing for listeners to do.
I think that's great. Let's get into that, Claire.
Sure. So for starters, I think it's a really good idea to outline your personal values, your
Mm.
strengths, your expertise, your interests, your passions. What do you care about? And conversely, what do you not care about? Because that will guide a lot of your future decisions about your investing thesis. That in itself can be a more lengthy exercise, but I think we all have a pretty good sense of our own strengths and expertise, our interests and our passions. So listing those out going ahead and putting them down on paper or on a whiteboard, um, and then starting to think about your appetite for risk. So identifying what your appetite for risk is can help you determine how comfortable you are for certain valuations and terms. And for those who aren't familiar with the venture asset class, one of the things I would do before even developing this investing thesis is read the book Venture Deals. Maybe even do the course. It's a free course. The book is written by Brad Feld and Jason Mendelson, two angel investors turned professional VCs who are incredible teachers. And they work with Techstars and Kaufman Fellows to create this free course that is offered usually twice a year online, and you can kind of do it at your own pace. So I would start there because I can start getting into terms that can sound, confusing if folks haven't dug into what a term sheet looks like and what the valuation or a cap looks like. For instance, I know a family office investor who was new to the asset class and was so excited about an opportunity that she decided to, even against the advice of the angels around her, she decided to go in on a deal that did not have a valuation cap, and she got burned. Those are the kind of things that if you have a thesis and you've spent some time thinking about deal terms and valuations and caps, you can have your own guideline for what you're comfortable with and what is going to leave you burned later on. Similarly, I would think about follow-on rounds. So if you're going to have a seed thesis and only seed, and that's the only stage at which you're going to invest, then you're going to have to be really disciplined about saying no and letting founders know upfront when you invest that that's the single time you're going to invest, and you're not worried uh, about your pro rata, about maintaining that in future rounds. You're just a one and done. There's nothing wrong with that as a thesis. There are, one of the things, one of the most fascinating events I held, a lunch and learn event at CTAN, was when I invited investors with different approaches to building their portfolio construction and their investing thesis. And each one of the three had a different plan for how they handle follow on rounds. One never did follow on rounds. Another one followed on to just about every deal that they thought was doing well. And the third one only followed on when an institutional investor was leading the next round and was
Mm,
de-risking it to an extent by doing that.
interesting.
How different do you think those three portfolios were in terms of performance?
I'm thinking that there was probably a shift of return level of 30 or 40%.
Zero. There was
Zero. Oh,
no
wow.
difference. There was no difference. I mean,
Mm,
it was minuscule difference in the portfolio success and unrealized and realized for these three
mm,
portfolio, the ways in which they were handling follow-on opportunities into their existing investments. And the reason was because all three of them had a thesis and they stuck to it. They knew what they
mm.
wanted to do, and they stuck to it.
When and so as you set a thesis would have some tuning, right? As you go through, would it
Oh yeah,
have some level
absolutely. So
of it?
I'm only halfway through the
Ah,
development. You're getting to the last point. So
okay, got it.
the next point would be to spend some time thinking about your mindset. Are you more diligence focused or are you opportunistic? Meaning, are you more focused on the metrics of market size and revenue and go to market strategy, or are you more of a gut feel investor?
Mm,
Or are you somewhere in between? And how are you going to think through diligence versus your gut feeling? How are you going to balance those? How much diligence do you want to do? How much do you think is important? This is
Mm,
also something to keep in mind when once you've developed this thesis, you can actually apply this to how you think about investing in funds as an LP. So you can talk to the GP you're thinking about investing in and ask them, are they more diligence oriented or more opportunistic? They might have
right.
partners with different approaches. You know, there are very successful VCs out there who go almost exclusively on gut, and then there are very successful VCs who go by metrics and stats and data.
Mm,
So it can be, and sometimes those VCs, those GPs are on the same team and they balance each other. So um, another point that I think is really important is analyzing your deal flow. So
mm,
recognizing market trends. So back to the personal values, if you've already determined your strengths, your expertise, your interest, your passion. That will tell you the sectors you want to invest in. And then spending time recognizing market trends in those sectors and exploring new sectors is part of diversifying that portfolio. And ideally, as you're developing this thesis, you're not just thinking about the sector you know. If you
mm,
can surround yourself by other with other good investors, other people who are exploring this asset class or already know it, then you can invest alongside them knowing that they know their sector, and you can
mm.
diversify more into other sectors that way. So putting all of your baskets in B2B, all of your investments in one basket, B2B SaaS,
Right.
in one sector, not going to be as diverse of a portfolio as would be ideal. Do you want to expand into healthcare or climate tech or CPG? What do you want to avoid? What do you know you're not going to be any good at? And to your point, finally, a thesis is never static. This
Mm,
is something that you should reevaluate at least annually, because you grow and you learn as an investor if you're doing it right. And as a result, you'll find that there are things in your thesis that you'll want to revise or expand upon.
and I'm sure there's room in there, right? You're incorporating your lessons learned all the time of,
Exactly. You're constantly reevaluating as you learn lessons, as you realize, oh gosh, I didn't do a thorough enough background check on this founder. I didn't work my
mm,
network to find out the pros and cons of this person as a leader. Or the founder told me that the market was this size and I didn't check to make sure it really was.
mm. And so are there guidelines when you think about the 20 or 30 investments as far as what kind of diversification that you would want across, let's say, industries, or, let's say, channel models, B2B versus B2C?
Here again, it has to do with your comfort level.
Mm,
A lot of investors I know in Austin, in particular, historically have been more comfortable with B2B. B2C is a tough space, but then a lot of the Bay Area investors are much more comfortable with B2C. So it depends largely on your own knowledge and expertise. What is your business background?
mm,
Where do you think you can have the most impact with your angel investments? One of the reasons why people get involved in this asset class is it's one of the only ones where you can really be hands on and have a chance to be a resource for the founders in your portfolio.
I want to pivot the conversation a little bit. I think we walked through the thesis building, but let's touch base on this. Where so many people that I know think that once they stop working full time in tech in a corporate role, whether that be for a startup, whether that be for a public company, that they no longer have a opportunity in tech.
Mhm,
When I think they couldn't be more wrong, that in this ecosystem and growing these amazing companies, supporting different founders, there's a myriad of roles that are available to them.
mhm.
What are you seeing out there where you could take somebody with deep industry experience and they can work in this ecosystem?
Oh, I would want to immediately introduce them to some of the accelerator leaders around town, because whether it's Capital Factory or TechStars or Sputnik, ATX, for Austin locals, there are accelerators in most significant startup communities all around the U.S. and internationally. So as long as you're in a community that has some level of startup support, then you can find an accelerator and plug in and become a mentor. Now, I think it's important for those who have never been a mentor to startups to realize that this is not going to be a paid role, and you should never ask for payment as a mentor until you've developed a really deep relationship with that founder. And usually it'll be the founder who asks you if you would join them as an advisor, and they offer you some stock. Um, so it's giving back. You've been successful in your career. By no means does that mean your career is over. You have a chance to teach founders, to support startup leaders in your community and beyond, um, how and why they can be successful. And if you have specific experience, say you spent your career in marketing or product development, you can bring a level of expertise to the table uh, that is unique and that a lot of companies could really use.
Right. I mean, you could be a SaaS buyer on the business side who,
Yep.
has been structuring those particular types of deals and can give tons of insight
Yep.
there as well. And I know there's opportunities. You mentioned mentorship, advisors. I know we talked about board seats. There's even, the opportunity to consult in different scenarios as well,
Mhm.
depending on how deep your expertise goes.
Yeah, certainly. Although I do think that a lot of people go into consulting in the startup ecosystem thinking there's a lot of money to be had, and most early stage startups don't have a lot to hire consultants. So if you're looking to do consulting with startups, I would encourage you to look at the companies that are really well funded, maybe Series B or Series A and beyond. Um, but if you're whether you're retired or taking a sabbatical and exploring your next thing, getting involved in the venture asset class is a great way to explore that next thing. First of all, or if you're retired or on just have had your successes, and we're not of the age where we're going to call it retirement, we're going to call it sabbatical, permanent sabbatical. Um, that Another thing you can do is bring that expertise to bear as an independent board member. Independent meaning you don't have an investment or a stake in that company, and you're bringing an independent mindset to that company's board. um, One of the things that I think was really interesting about going back to that portfolio metrics lunch and learn I had at CTAN was one of the investors spoke about how his winners were the ones where he had a board seat and wrote a big check. His losers were the ones where he was passive, either not on the board, not even a board observer, and wrote a much smaller investment. So his takeaway was the diversified portfolio is important, but for him, success happened when he was investing with passion and all in. So, that's a I think an important lesson for thesis development. Another one is we all learn from our failures more than we do from our wins. And when you're thinking about getting involved with startups, know that those failed investments uh, are an opportunity for a lesson learned. So what was the reason behind that failed investment? Was it lack of due diligence on your part? Were you too emotionally involved and funding cash burn? Um, were you perhaps believing in the fallacy of first mover advantage? Second mover sometimes, actually often, does better than first mover. So doing a post-mortem on your failures and reincorporating those back into your investment thesis is part of thinking about how you want to be involved in the ecosystem, because when you learn from your failures as an investor, just like when founders learn about their failures as a founder, we all become stronger and the ecosystem becomes stronger.
I couldn't agree more, because it's the process of failures evolving into lessons learned, and I think
Hmm.
they can only do that when you reflect on them.
Yeah.
Otherwise they just stay as failures. You have to process them into a lesson learning. You have to write that script. What does that look like? What was the lesson? What was the takeaway? And then as investors, the more we do that and we fold that into our investing knowledge base, translate that into our new updated investment thesis, that means that we continue to take risk out of our portfolio, and
Hmm.
we continue to put, more wins on the board.
Yeah,
And
and one last thought I'll add is that one thing that I think that is perhaps easier to forget than it should be is that when we're investing in startups and investing in this asset class, we're investing in people,
mm,
and founders need support. They don't just need a check; they need advice and mentoring, and they need us to also ask how they're doing. Founder mental health is a real thing, and found being a CEO founder, whether solo or co-founder, is a lonely experience, and we as investors can help make that a better experience by being we don't have to be rah 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 cheerleaders. We can be
mm-mm.
authentic and meet that founder with emotional integrity, and support them as we're pushing them to do better.
Such an important point to call out. And especially I think for some of us who, I transitioned from corporate roles into entrepreneurship, and I understand that entrepreneurship is a lonely journey, and especially if you are leading a startup company and people expect so much of you, aren't taking it from you. We need to take our experiences that we had at these hyper growth companies, coach them, guide them, be that shoulder for them. And I think, to your point, Claire, what I've come to understand is that, we can be in that positive mode, we can be drive on the gear shift, we can be going backward and reverse, but sometimes just letting the car idle in neutral is exactly where we need to be.
I'll also add one other thing when we're thinking about building our investing thesis, and that is, um, I'm going to bring up what some people will consider an elephant in the room, but I think this is an important consideration, and that is diversity. Diversity of person, diversity of sector, diversity of stage. Um, the research is very, very clear that the best performing companies are those that are led by gender diverse teams and ethnically diverse teams. And if we as investors make a concerted effort to find and get to know um, a vast plethora of different types of founders, we are much more likely to have a successful portfolio and the returns that we want on that portfolio.
I couldn't agree more on that either. Is that, what I've seen as well is the diverse teams, diversity of ideas and people that come together,
Hmm.
help navigate through all these different situations because of all the different contexts that you can bring. And ultimately, what sits on the other side of a company and what you're building is what? Customer base. And that customer base is going to be the same thing. It's going to be diverse. Many of these
Hmm.
companies want to go sell not just here in the United States, they want to go sell all over the world.
Yeah.
And so we have to all come together and originate with that same, diversity of ideas. I also like the bringing in people who have worked in different sectors. I know for myself, being in, more public tech, than bringing in people who were, let's say, in the military and
Hmm.
had that experience for a number of years, and brings in that diversification of idea. Or for myself, I was at a very large corporation, then I started going into pre-IPO startups, and so you went from big to small, and so I would always understand where we're headed, where we're going. That was one of the dimensions that I was able to bring to the team. All those different ideas, people, thoughts, places, make for a stronger outcome.
Yeah, and the stats are there to back that up. For instance, at Portfolio, and Portfolio, by the way, exists to activate women as LPs in the VC asset class, because women historically don't tend to think of angel investing in VC as something where they should put their money. But women control more than half the wealth in this country now, and they also control the purse strings for 80% of the buying decisions in the home, and that's only increasing. So uh, one of the things that I think is just proof to the point I was making around diversity and your support for it is that our best performing fund by far at Portfolio is the one that is focused on investing in Black, Latino, Latina, and LGBTQIA plus founders and or companies that are addressing those communities. And that fund is unrealized IRR, of course, but it's performing in better than the top quartile of funds.
Wow,
So
that's amazing.
there's something to be said for seeking out diversity of person and idea and sector and all of that. I think socioeconomic diversity is important too.
Truly is. Well, I think that you and I, Claire, could jam for hours more, but unfortunately, we do have to put a bow on this at some point. We always hit it up with what we call the fire round, where I'm going to ask you 5 questions. Just give me some crisp answers here. What would be the worst career advice that you ever received?
Where's career advice? Oh my goodness, I don't tend to think in worsts. Oh, wow. I don't know if I can come up with a crisp one. Stay in nonprofits?
Okay. Yeah. Did somebody tell you that at some point?
Yeah, they thought that nonprofits were my future, and I thought so too at one point. But it turns out I didn't think of it as bad advice at the time. Turns out that wasn't where I was supposed to be.
Well, and I think sometimes well-intentioned mentors don't want us to get hurt when they see us taking a risk, but
Mhm.
I would say to that person they didn't know what you were about to become. So, anyway, I
Neither
good
one
one.
of us knew what I was capable of at the time. In fairness,
So, how do you keep learning
how do you not?
in this day and age, right?
Yeah, so I read a lot, podcasts. I stay abreast of the news. Um, One of the most important ways I keep learning is by seeing startups. I have a chance to
Mm,
deep dive and due diligence into sectors I have very little knowledge of, but I learn in that experience, and that's one of the reasons why I love this asset class so much is I have a chance to see cutting edge technology and cutting edge solutions in healthcare and other sectors that I would not otherwise be aware of or learn about.
that's great. What do you do to recharge? How do you get away from it all?
Cuddle with my pug.
Oh, pug
No,
cuddling's a thing. That's
yeah,
a
pug
thing.
cuddling is a thing. No, I love to travel, especially internationally. And that for some people that probably doesn't sound like a recharge opportunity, but it just it gets me. It's having a chance to see new places and experience new experiences and go to a place where I don't know the language. That's the goal.
I love it. Yeah, I'm the same way. What advice would you give your younger self starting to work in VC?
Hmm. I don't know if this is advice from starting to work in VC or just advice younger self generally, but stop listening to the negative inner voice, the critical
Mm,
voice. I should have
yeah.
gotten rid of that a long time ago, a long time sooner than I did, and I think that this is something I don't know if men are challenged by this. I know a lot of women, high performing CEOs and top leaders who deal with the negative self talk, and that's something that none of us need.
Oh yeah. Yeah, yeah. I mean, I know I can struggle with it too. Being my own worst critic
Mhm.
is brutal, and yeah,
It's a
100%.
conscious decision to let that go, and I think it's an important one. We can be the better version of ourselves when we let go of that critical self-talk.
Right, choosing which voice we want to support, which one we want to listen to, because sometimes it'll be there in the background, but we want to give the positive one more of a voice.
Mhm.
So we're gonna bookend it with a worst, but I think you can answer this one. What's the
Mhm.
worst investing advice you ever received?
Mm. Oh, wow, that's a really tough one. I think, some of the worst advice I've seen is to follow on every chance you get,
Mm,
and I think that's a really bad idea because you can end up, following on, chasing good money with bad and just
yeah.
sinking money into a hole where that company is just not gonna survive. So, knowing when to cut bait, cut your losses, admit that that investment is lost is really important.
I think you're right. Yeah, you got to know when to stop the proverbial bleeding.
Or don't even start it.
Right. When you have a thesis, right? You
Exactly. You can
exactly.
control it. Indeed.
Well, Claire, I can't thank you enough. Thank you so much for your time. I got so much value out of this, and I'm sure other people will too. Thank
Well,
you.
thank you. This was a real pleasure, Christopher. I appreciate your time as well.
Thank you so much for listening. I would ask that you do one thing. If you can go to Tech Careers and Money News, you can sign up for our latest publication. In Tech Career and Money News, we're going to give you a weekly publication that gives you insight into tech careers and equity compensation. How do you trade your time and talent for equity? What are some of the skills that you need to understand? Millionaire mindset. How do you grow your portfolio as you're growing your career and the skills that you need to manage it? Go sign up today. And if you like Tech Careers and Money Talk, you're going to love Tech Careers and Money News. Thank you. Bye.